Traders, this video is all about oscillators, technical indicators that measure momentum in the markets. While they can be used in various ways, today I'll focus on identifying overbought and oversold levels and explore one of their most powerful applications, divergence. This technique can help spot potential turning points in any financial market before they happen. I'll also reveal why relying solely on a single indicator can be a costly mistake. There's a number of oscillators such as the stochastic and commodity channel index that you can see behind me. But in this video, the oscillator that I'll be covering is the relative strength index, or RSI. The RSI can help you detect shifts in momentum and potential turning points before they occur. We'll dive into overbought and oversold zones, uncover powerful divergence signals, and most importantly, find out how to combine RSI with other technical tools that I've gone over in my previous videos. By the end, you'll have the confidence to trade smarter in any market. Let's get started. Up here with the red and green candlesticks, we have our price chart, which is always the most important chart. Down here, we have our oscillator, which is the relative strength index, also known as the RSI. Realistically, I'd never have the oscillator as big as the price chart, but as I'm explaining it today, that's why it's going to be so big, may even be bigger. To keep things clear and not cause any confusion, I've color coded and labeled the RSI levels. So the upper horizontal line in orange, which is overbought, and at the 70 level that you can see over here on the right is overbought. And the green horizontal line at the bottom is oversold, which is at the 30 level. When you're using RSI to identify overbought, you're waiting for price to have a rally and the RSI to be over the 70 level. That's an early indication of a sell signal, which happens here and would have been profitable. When you're using the RSI to identify oversold, that's when you have a sell-off and you're waiting for the RSI to be below the 30 level, and then you'd have a buy signal. Using the RSI to identify overbought and oversold levels is a very simplistic approach to identifying trading opportunities. It is profitable when used at the right time. However, in this example that we can see now, when the market is in a strong uptrend, we see that the RSI is in oversold territory from this point here, from this candlestick. However, the market continues to rise, and that would have been a false signal. When we use the RSI in this simplistic way, we can see that when we have strong selling pressure, the RSI goes into oversold territory. And if this was your rules, you'd enter the market for a buy position. But as you can see, the market continues to go down. So this is another example of where using the RSI in a simplistic way, just using overbought or oversold territory, doesn't work. If you do decide to use the RSI in a simplistic way for your trading decisions, it will be a good idea to add a different filter to your trading strategy. A filter such as moving averages. Moving averages will help you determine the overall market trend direction. So in this example, if you did have the moving average filter, you'd see that you were in a downtrend. And then if you was in a downtrend, it would be a bad idea to take a buy signal. You can then do the opposite for sell signals. If you're unsure on how to identify market trend using moving averages, then you can check out my previous videos and I'm sure that they will help. If when you're using the RSI, you notice that sometimes the RSI is far below the oversold level or far above the overbought level, what you can do is you can double click and change the length. So I'll just do that now. Currently the RSI length is on 14. The higher the length, what you'll see is that the less reactive the RSI will be. So I'll go to the extreme so you can see that now. Now you can see that the RSI is neither in oversold territory or neither in overbought territory. So it's far less reactive. Equally, if you'd like the RSI to be more reactive, what you can do is you can simply go to the extremes again. So previously when we first started, we were on 14. Then I moved up to above 30. Now, if I go to 5, you can see that the RSI is having a lot more readings in overbought and oversold territory. There's pros and cons to having the RSI more reactive and less reactive. When the RSI is more reactive, you're going to have more trading opportunities as well as having more false signals. When the RSI is less reactive, you're going to have less trading opportunities and less signals. I'll now be showing how to use the RSI to identify bearish divergence. Bearish divergence is when price makes a higher high, but the RSI makes a lower high, which is an early indication that the market is likely to turn and it's a sell signal. So the first thing we identify is the first high, which we can see here. First high will also be known as the previous high. I've also marked out the same area on the RSI. So up here we have price, down here we have the RSI. As price moves, the RSI also moves. So as I've marked out the high on price, I've also marked out the high on the RSI. After that, we're looking at the second high, also known as the current high. This second high is higher than the previous high, which was this high. Here, I've also marked out the high point for the second high on the RSI. So the second high on price is up here, and the second high on the RSI is down here. Now that everything's labeled on the chart, I'll explain bearish divergence. So bearish divergence is when price makes a higher high, but the RSI makes a lower high. On the chart, we have two highs, high 1 and high 2. The current high, which is the second high, needs to be higher than the previous high, which is the first high. That's also represented on the chart where I have this trend line. When the trend line is sloping upwards, that's to indicate and to show that price is going upwards. Price is rising, or price has made a higher high. On the RSI, the current high, which is the second high, is lower than the previous high. That's to show that the RSI strength has weakened. So even though price has made a higher high, the RSI or the strength of the market isn't as strong as when price was at this high. So it's an early indication that the market is losing strength and the market is likely to turn. That's also accompanied by some bearish engulfing candlestick pattern that we have here, which is a key reversal candlestick pattern. I also go over it in my previous videos, and that's a sell signal. So this trade would have made profit. Bearish divergence may be a bit difficult to understand, so I'll break it down in the use of concert tickets. So there's a music artist, the artist is charging £10 per ticket. Many people would like to buy the tickets for £10. So there's a lot of buyers, there's a strong uptrend, which is what we can see over here. The market, the buyers are buying, there's a lot of strength in the market, that's what we can see here in the RSI. Then what the artist may decide is to up the price from £10 to say £100. At £100, there's still buyers, but there's a lot less buyers. So here at £10 is when there's a lot of buyers, and here is when the artist changes the price to £100, and this is when there's a lot less buyers compared to the previous amount of buyers. What that then means is that because the buyers are reducing, it's an early indication that there will eventually be no buyers and price will decline, which is what we can see here. So going back to our concert, this could be the market cap. No one's willing to buy any more tickets. Then we have an early sign of a reversal, which is the bearish divergence. Our confirmation of the market turning can then be the bearish engulfing candlestick pattern, which is what we have here. And again, that's on the previous video. But that is an easier breakdown or easier explanation of bearish divergence. Hopefully my explanation as well as my concert analogy has helped with understanding what divergence is. While for bearish divergence, it's literally the opposite way around for bullish divergence. Bullish divergence is when price makes a lower low, but the RSI makes a higher low. And that's an early indication to buy. The best thing to do would be to wait for more confirmation, such as a key reversal candlestick pattern, or you could also incorporate moving averages or support and resistance into your strategy. That wraps up this video on oscillators, RSI in particular. If you found this video helpful, do check out my earlier content for even more insights. If you plan on adding the RSI to your trading strategy, it's imperative that you backtest the methods I've shown first before using them in live markets. Protect yourselves at all times, get the data, get the statistics, then decide if you're going to add it to your strategy from there. Keep an eye out for my upcoming videos, a lot more content coming. If you have any further questions, feel free to leave a comment below or reach out to me via email. I'll leave the email in the description, or head over to my website, trader187.com. I'd be happy to hear from you. For those ready to take their trading to the next level, I offer private mentorship and a private trading group. Shout me. Thanks for watching, and I'll see you on the next one.